474,000 barrels per day, a record production, and an EBITDA of plus 77%. And yet the stock is trading at a price to sales of 0.7. Harbour Energy has just delivered the best annual figures in its history, completed a $3.2 billion acquisition in the US Gulf, and pays over 8% dividend. Is this the cheapest oil stock right now? Or is there a catch behind it? And we'll look at that today, as always, without marketing glasses. Welcome back to MBCapitalStrategies. My name is Marco. Today we continue with the upstream series, namely with Harbour Energy, one of the largest independent oil and gas producers in the world, and probably one of the most underrated. Today I want to go through the complete 9-point analysis. That means business model, fundamental data, valuation, dividend, competition cycle, risks, and the scenarios. And at the end, a clear conclusion. So let's get started. Harbour Energy was formed from the merger of Premier Oil and Chrysler in 2021. In 2024 came the mega deal, the takeover of the upstream division of Wintershall Dea for around $11.2 billion. And just now in February 2026, Harbour has the $3.2 billion acquisition of LLOG Exploration completed, a pure deepwater producer in the US Gulf. The geographical setup today: Norway largest production center, stable regulation, low tax burden through investment incentives. UK North Sea historical core business, including Germany's largest oil field, Middle Plate. US Gulf of America, new through LLOG. Oil-weighted deepwater portfolio with long reserve life. Argentina with Southern Energy LNG project with 15% stake, operational from the end of 2027. Mexico, Zama oil field. Harbour as operator comes on stream towards the end of the decade. Then we also have departures. Vietnam was sold. Indonesia is being divested for $215 million. And this is no longer a small UK E&P. This is one of the world's largest independent upstream producers, with operations in 6 core regions. The strategy is clear. Concentration on Norway, UK, and now the USA as core markets, with growth options in LATAM. CEO is Linda Cook. A former Shell executive has bought up a massive portfolio in just 2 years. The integration of the Wintershall assets went smoothly, and LLOGC is the next step toward diversification away from Europe. Let's also take a look here at how I'm invested. In total, I hold 40 shares. My entry point was €2.50, currently with a percentage gain of 35% and already a net dividend of €6.44, which I've already received. I know it's a very small position right now, but I bought in back then when the stock was, let's say, a bit smaller and, in my view, not quite as certain as it stands today. If I see favorable prices again, then I will definitely buy more here. We can also analyze later at the end where roughly my target purchase price would be. The 2025 annual figures were just freshly released on March 5th. Production of 474,000 barrels of oil equivalent per day. That's a record increase of 84% over the previous year, with revenue of $10.3 billion. In the previous year, we had $6.2 billion, which corresponds to a gain of 66%. We have a free cash flow of $1.1 billion compared to $0.1 billion in the previous year. That means we have completely tenfolded. An operating cash flow of $7.3 billion and a capex of $2.3 billion. The operating costs here are $12.80 per barrel, down 22% compared to the previous year. We have a realized oil price after hedging of $69 per barrel. In the previous year, we had $82. We have a net debt of $4.4 billion at the end of 2025. After LLOGC, it's approximately $7.2 billion. The revenue and EBITDA explosion comes from the full year impact of Wintershall. but the realized oil price was only $69, significantly below spot. Harbour hedges aggressively, which in an environment of rising oil prices due to Iran limits short-term upside but protects the downside. The unit costs of $12.80 per barrel are strong, meaning even at $50 oil, cash flow remains. Let's move on to the valuation, and this is where it gets interesting. We have a market capitalization of around 4.7 billion British pounds. We have a PS ratio of 0.71 for a producer with $10 billion in revenue. Absurdly low. We have an EV/EBITDA due to the high net debt. After LLOG, the enterprise value is approximately $13 billion. So an EV/EBITDA of 1.8, and that is extremely cheap. Analysts are setting an average price target here of 274 pence, which is 12 to 13% above the current price. The market is pricing in a UK tax risk here, a high debt load after the acquisition, and general E&P skepticism as well. Anyone who looks beyond the headlines stands. Anyone who looks beyond the headlines sees a company trading for less than twice its operating cash flow. Now let's move on to the dividend. Harbour has just introduced a new dividend policy, and it is crucial. We have a payout target of 45 to 75% of free cash flow per year. A base dividend of 16.10 cents per share. That is approximately $300 million annually. 2025, a final dividend of 8.05 cents per share. That is $150 million. The payment here is on May 20th, 2026. The current dividend yield is at 8% trailing. The strategy, as long as leverage is above 1, payout at the lower end of 45%, as soon as leverage falls below 1, upper end 75%. And that is smart. Harbour is prioritizing debt reduction after the LLOG deal, net debt of $7.2 billion, leverage slightly above 1. And then opens the dividend tap further. The guidance says that in 2028, leverage should be at 1, then more cash will be returned. For my YOC system, with an entry at, 2.5 and a base dividend of 20 pence per share, I get a yield on cost of about 8%. That lights up in my dashboard. And if oil prices stay high because of Iran, the variable component could be added. Since 2022, Harbour has distributed an average of 40% of its free cash flow. The new policy raises the target to 45 to 75%, and that is a clear commitment. Now let's move on to the competition. Harbour is the largest independent European E&P, comparable to Aker BP, more stable but with less growth. Ithaca Energy, smaller and higher UK tax risk, and Vår Energy. Similar profile but only NCS and DNO. Higher political risk. What makes Harbour unique is its geographical breadth. No other independent E&P has Norway, the UK, the US and US Deepwater, Argentina and Mexico in its portfolio at once. And that reduces the cluster risk significantly. If UK taxes rise, the US Gulf cushions the blow. Through LLOG, Harbour is also established in the US Gulf with 475 to 500,000 barrels per day. And that is a volume that otherwise only the majors deliver. Let's move on to the cycle analysis. Where does Harbour stand in the oil cycle? The oil market was at an equilibrium with a slight oversupply last week. The IEA forecasts a record surplus for 2026. Brent was at $72. Then came the Iran war. Since Saturday, we have a completely new situation. The Strait of Hormuz is closed. Brent is at $80 after hours, with forecasts of $100 and more. And that fundamentally changes the cycle. For Harbour, that means higher realized oil prices equals more free cash flow, but Harbour hedges aggressively. Part of the upside is capped by hedges. European gas prices, Harbour's second major revenue stream, are also rising because LNG is affected by Hormuz. BP is evacuating personnel from Iraq. Harbour has no Iraq exposure, so it benefits without operational risk. My assessment, Harbour is cyclically well positioned. The low unit costs of $12.80 per barrel offer downside protection. The Iran premium offers upside potential. And we are in the sweet spot of the cycle here. Supply shortage plus rising prices plus operational discipline. Now let's move on to the risks. We have debt, and it is high. After ELOG, net debt is at $7.2 billion, leverage is slightly over 1. With oil prices falling below $50, it gets tight. Harbour needs sustained high cash flows for deleveraging. The plan envisions leverage until 2028. Realistic at $70 oil, risky at $50. UK Energy Profit Levy. The British windfall tax on oil profits remains a sword of Damocles. Harbour now has more Norway through Wintershall assets exposure, which relatively lowers the United Kingdom risk. Plus, the Waldorf acquisition brings United Kingdom tax losses worth an estimated $900 million. Mittelplata Court ruling. On February 26, 2026, a court questioned the operational plan approval for the Mittelplata production island. Environmental Action Germany is suing due to a lack of an FFH assessment. Harbour has filed an appeal and operations are continuing, but Mittelplata is Germany's largest oil field. A production stop would be material. Then we have the LLOG integration risk. $3.2 billion acquisition just recently completed. Wintershall integration went well, but now LLOG is coming on top of that. US Deepwater has different regulatory and operational requirements than the North Sea. And we have the hedging risk. Harbour hedges aggressively with rapidly rising oil prices. For example, now with Iran, participation is limited. The realized price for 2025 was $69. Even though Brent was higher on average, let's now move on to the full scenarios. In the bull case, we have a price target of 350 to 400 pence. Oil prices stay at $80 due to the Iran premium, LLOG integration runs smoothly, and the US Gulf delivers. Deleveraging faster than planned, dividend increases, Mexico Zama and Argentina Southern Energy on schedule, reserve replacement over 100% confirmed. In the base case, price target of 270 to 300 pence, oil normalizes at $65 to $75. Production is stable at 475 to 500,000 barrels of oil equivalent per day until 2030. Free cash flow grows to $1 billion by 2028 as guided. The dividend remains at an 8% yield. Leverage drops to 1-to-1 by 2028. Mittelplata risk is resolved. In the bear case, price target of 150 to 180 pence. Oil prices fall to $50. Rapid Iran de-escalation plus oversupply. LLOG integration has problems, capex increases. The United Kingdom increases the energy profits levy further. Mittelplata must stop production and the dividend is cut for debt reduction because it is delayed. Where would I potentially buy more here now? As mentioned, currently at about $4, the 52-week range is between $2.08 and $4.10. Current daily range at $3.87 and $4.10. Where would I buy more? We're seeing a rejection right now at the Fibonacci retracement. And here in the green area, in my opinion, an ideal purchase price would be at the 61.8 Fibonacci. In that case, that would be at $2.05. $2.85 in the ideal case. Also here, this is currently my own tool, so to speak, that I'm building right now. We can see the complete fundamental data and the dividend in general. And here currently, yes, we're at the peak and this is where profits are being taken ultimately. Yes, so that would be my target, so to speak, where I would buy more at $2.85. Harbour Energy is trading at a price to sales of 0.7 and an EV to EBITDA of under 2. Production is at record levels. costs are low, and the new dividend policy with 45 to 75% free cash flow payout shows that management is serious about shareholder returns. The risks are real, especially the debt after LLOG and the UK tax environment. But that's exactly why the stock is so cheap. The market is pricing in the worst case scenario while Harbour is delivering the best case operationally. As I already mentioned, I currently only hold a small number of shares, but I definitely want to add more here. I just showed you the price where I would buy more. And that is, of course, only my personal strategy and my buying scenario. Of course, everyone has to decide that for themselves. In one sentence, Harbour Energy is a cash flow monster with an 8% dividend that the market treats like a value trap. But the numbers tell a different story. If this analysis helped you and you liked it, please feel free to leave a thumbs up. Otherwise, I'd be interested in your opinion. What's your take on Harbour Energy? Did you know the company or is it new to you? If you're new and don't want to miss any more videos, I'd be happy if you subscribed right here. Otherwise, as always, this is not investment advice, but just my personal strategy. I wish you all successful investing and see you in the next video.